And it's my actually second visit already being part of this international conference. I think I came back in 2010. It was perhaps the second BEROC conference, a very nice environment, and actually I'm pleased to be back. So I think in my presentation today, I'm going to continue the topic of access to credit, so credit access, but focusing specifically on these marginalized groups, as I call it. So it's more like small and medium-sized firms, which actually lack credit history and which are normally or often are excluded from provision of loans by incumbent banks, or like so either banks engage in credit rationing, or they tend to compensate for various risks via, say, increasing the cost of credit for SMEs. So the paper that I'm presenting, it's a joint work with my colleagues. So we have 4 courses in this project, and it's result of actually our joint engagement in a research project, SOPUS research project, which was funded by National Science Center of Poland. I'll quickly go through the motivation behind the papers, and I'll provide some contextualization of our research within the literature, focusing on both theoretical arguments and then empirical evidence. Based on this, I'll flag up our hypothesis that we postulate, and discuss then the research design. So it's pretty much an empirical paper. And finally, drawing some conclusion and policy-making implications. So, in this paper specifically, we explore to what extent then the recent developments in financial innovation, specifically happening in banks, helps then ease financing constraints on this more excluded groups, as I call, and as customers, like small and medium-sized firms. So why do we focus on SMEs? It's just because they tend to form the backbone of the European Union economy. They account for more than 50% of the gross domestic product, but also employment. And the literature, vast already emerging literature, documents that actually SMEs are by far financially constrained compared to larger firms, and also this places in turn constraints on their growth opportunities. So that's pretty much our motivation. Why? I mean, theoretically, talking about financing gap between SMEs and larger firms, so it's largely attributed basically to inherent information opaqueness of SMEs, and they were primarily attributed to this lack of experience, lack of credit history, lack of reliable reputation, which all then raise risks for banks in terms of funding than SMEs. This is also further aggravated by weak financial performance normally of SMEs, with a high percent of them experiencing, say, failure during the first at least 3.5 up to 5 years of their operation, and also by the lack of collateral. So that's explained why generally we see then banks engage in either in credit rationing when it comes to funding SMEs via provision of debt, or when or via, say, increasing, for example, the cost of intermediation for SMEs. So the recent actually developments or advancement in financial technology spanning across different sectors like credit service provisions and personal finance, and then also welfare management. They all were largely kind of pioneered by fintechs, financial technology or big technology companies, and created actually new funding opportunities for more kind of marginalized or excluded customers, including like small and medium-sized businesses. So looking just at this graph, you can see how the proportion of non-bank financial institutions which with a large actually share of this financial institution being represented by fintechs, has increased substantially over the past decades. These are the green bar here, and in fact, exactly like other financial institutions like fintechs, they tend to account for the largest share of non-bank financial institutions, and in the specifically 2000, that was 30%, as compared to, for example, if you talk about traditional banks, it's 38%. So they become to play a more important role in founding, actually, the real economy. Right. So the more specific sub-questions that we address in this study is whether bank financial technologies and helps increasing access to credit for SMEs, whether then it has any effect on debt maturity, to what extent then it helps reducing cost of credit, benefit more specifically younger or smaller firms, which are considered to be more informationally opaque, and whether it then help reducing the need for collateral, and also we kind of place all this consideration of this relationship in the context of different credit market structures, say dominated by either traditional banks in the form of presence of branches, or where we have higher penetration, for example, of fintech companies already in credit markets. Right. In terms of theory, actually, financial technologies then argue to reduce information frictions, exactly via, say, greater information availability and data sharing, and also then in this way, this high availability of information and sharing helps then improving credit risk evaluation of customers and specifically then benefiting more excluded customers or borrowers. Similarly, like machine learning models, the use of machine learning models and then also artificial intelligence algorithms, they help then for more precise assessment of credit applications of borrowers, but also helps them monitoring borrowers in real time, and all these actually then, I mean, in this case, great availability and use of information helps to substitute for collateral. So there is less needs than for collateral. And also, some scholars argue about that the application process with the adoption of financial technologies becomes faster, and then the lending borrower-lenders relationship is then less dependent on personal relationship. It's what we observed previously in the context of traditional banks actually serving their customers via, especially marginalized ones like SMEs, via developing more relationship lending. And some more actually evidence based on the US banks argues about that financial technology helps then increase operational efficiency of banks, and this should translate actually in the reduction of the cost of intermediation. But the studies are quite inconclusive in this respect. Specifically using this the sample of US banks, the scholars find that there is no significant effect actually on cost of intermediation from the side of financial technology. So while these kind of studies and literature provides more pros in terms of supporting the positive effect of financial technology on access to credit and also reduction for cost of intermediation for SMEs. We should bear in mind that there are various limitations or restrictions in place, specifically placed on banks in terms of using some alternative data when it comes to data sharing and using them specifically in the credit scoring models. It's more specifically the data which comes from social media, for example, and etc. So these may then affect banks in the sense that even if they increase lending, so they tend to go more for provision of short loan rather than long-term loans to their customers. So they shorten then the credit maturities. They may also demand then for additional collateral or then increase the cost of credit to compensate for risks by when increasing the provision of loans to such customers. So based on this, we postulate a hypothesis, and we expect, first of all, that the impact of bank financial innovation would be in stimulating actually SMEs credit to debt. And we expect that this effect would be stronger actually on short-term credit provision as opposed to long-term when we speak about maturity. In terms of effect on the cost of funding, I think we rather take the views from the earlier studies done by US scholars, more specifically Philip Horn. He observes, for example, in the sample of US firms, banks, the increase in operational efficiency, but he argues that this does not translate actually into reduction in the cost of intermediation. But further, we argue that referring to some studies done on fintechs, more specifically the work from DiMaggio and his colleagues, that what observed in terms of fintechs is that there is increase in this engagement in moral hazard behavior from the side of borrowers. And this increases obviously the risk of funding such borrowers. And so they tend to compensate for this by increasing actually the cost of borrowing. So handsomely, we also postulate that financial innovation at banks is likely to increase the cost of debt. Now, we also zoom then the focus going from small and medium enterprises in general to zooming into actually startups or younger firms, and also firms which are small in size, because we consider them the most informationally opaque. And since we argue about that financial innovation is to reduce and mitigate financial friction, so we think that the effect should be stronger actually on these younger and smaller firms. So consequently, we expect then them to benefit more in terms of access to credit if banks engage in financial innovation, but also in terms of getting access to more cheaper credit. All right, yeah. So further, we postulate hypotheses regarding to collateral, expecting actually that the need for collateral to be reduced with actually availability of bigger data, sharing of the data to kind of appearing to substitute then for collateral. And we consider also the effect of financial technology, as I said, conditional on credit market characteristics. So in terms of access to credit, we expect less pronounced effect, where still we observe higher presence, for example, of traditional banks in the form of branches, but the effect to be more pronounced where we observe higher density of fintechs in the credit market. And in terms of the cost, we actually argue about the invest relationship. So we observe reduction in costs exactly in the when the environments have higher traditional banking presence, whereas there is an increase in cost of intermediation where the fintech market is more developed. Now, why we have so many courses is just because we have so many data sets to deal with by trying to answer these research questions. So we start with using actually Amadeus Bureau Van Dyck data, which is financial accounting data on firms, and we specifically use a sample of small and medium-sized firms here, spanning across European Union over the period of time from 2008 to 2019. We then match, so basically Amadeus data gives information, not only financial information on firms, but also the affiliation actually with banks as well. So it's how we get information on which individual firm is affiliated with which particular bank. The issue is that, unfortunately, firms report more than one affiliation, and here you can see actually while 70% of our sample, just above 70%, report just affiliation with one bank, actually about still 20% who report affiliation with two banks. That creates slight problem, but then we use various robustness checks in terms of trying to actually attenuate the effect of this affiliation with multiple banks. Now, we use a set source of data in order to collect information on financial innovations. And here we specifically use Crunchbase, CB Insights, also bank financial statements and public announcements, and use web mining to actually collect the data on various solutions, digital solutions, which were introduced by banks over time, including like automation software, the use of automation software, blockchain technology, data analytics, lending solutions, payments, personal finance, regulatory technology, and also we sum up all these aforementioned solutions just to get the overall indicator of financial innovation intensiveness of banks. Now, the model is actually, we use a number of dependent variables to answer our research questions, and we focus on the overall debt growth rate of debt of SMEs. We focus separately on short and long debt rate growth rates, and also we look at the ratio of short-term vis-a-vis long-term debt in order to gauge about the effect of financial innovation on the maturity. We employ as a baseline model, we employ panel fixed effects model, controlling for firm fixed effects, but also year fixed effects. And we introduce additionally like sectoral fixed effects in case if firms tend to migrate across sectors over time. It's not many of them, but it still happens in the data. So we also then control for firm level characteristics. There are quite a number of them, and these are listed here. I can expand more on this once if you are interested. So we leg them by one to, once again, also to attenuate the issue of indigeneity, or at least of these firm level characteristics in affecting our potential dependent variables. And we also control for main bank with which a firm is affiliated characteristics, including its size, loans, and the ratios of equity as well as deposit growth. And we add also country-level controls on the one hand side to capture then the credit market characteristics like fintech credit per capita provision, and we use also branches, number of commercial bank branches per 100,000 adults in order to capture then the presence of traditional banks in the credit market. Apart from this, we control also for business cycles via GDP growth and employment rate and the initial level of economic development via GDP per capita. Now, I skip actually providing all the results here. I mean, in the sense of a full length table, as it's quite lengthy. I mean, it's over 2 pages each table. So I just report the main results in terms of the effect of bank financial innovation. But if you are interested, the paper is available as a working paper, so you can follow this up and read in more detail. Right, so what we observe in terms of our hypothesis one, so in terms of credit growth, so we observe actually that bank financial innovation, if you look at all these different types of financial innovations, individually benefit increase of SMEs access to credit, and this effect is stronger actually on a short term credit growth as compared to long term. So in terms of maturity, what we observe is that banks tend to switch more from kind of relationship lending, where they could also provide like long-term credit, to more sort of increasing the provision of short-term credit. But in this sense, they tend to compensate for actually increased risk of potential borrowers. Now, we don't actually, looking at the base model, we don't find any significant effect of actually a cost of intermediation on the effect of bank innovation and financial on cost of the intermediation which SMEs encounter. But Only we find the significant result in the case of the use by banks of business analytics. If they employ this innovation solutions, this tends to then increase the cost of intermediation by SMEs, for SMEs. And the reason for this, as we think, so basically then banks get some alternative data which may not necessarily be to advantage of SMEs when assessing basically their creditworthiness. Now, then we actually look at the effect of financial innovations on smaller firms and also younger firms. And what we find is that financial innovation does not necessarily actually help then these opaque firms to eliminate financial frictions, at least in part of actually access to credit. But we find actually the significant effects then of financial innovation solutions across quite a number of them on actually reducing the cost of intermediation for younger firms, which are startups that could be potentially these high growth firms. Now, speaking about collateral, also there are some consistent results on that. We observe the reduced need for collateral when SMEs tend to obtain their credit. And by the way how we measure this is just we take the share of fixed assets as a proportion of total assets for firms, and then we look exactly at low collateral denote exactly the firms which have less than median share of this fixed asset as a proportion of total assets. And finally, speaking about credit market structure, so what we do find in terms of the access of credit, so the upper panel reports the results actually for the higher presence of traditional banks, and then the lower panel is in terms of higher presence of fintechs. So we observe that where there is a higher presence than of traditional banks, there is less actually scope for financial innovation to further increase, for example, access to credit. But we find some complementarity between actually financial innovation introduced by banks and then presence of fintechs in increasing actually access to credit by SMEs. Thinking about actually Igor's presentation just in this context, so either banks appear to be kind of free riders in this case, free riding exactly on the information that fintechs collect via alternative data, using alternative data sources. And actually, interesting thing that banks, there are various restrictions imposed on banks in terms of using some of this alternative information, especially coming from social media, in their credit evaluation models, whereas such restrictions are not in place on fintechs. That's why I'm thinking about more this free riding aspect of this complementarity issue. The other thing could be that still in the markets where we observe higher presence of fintechs, I think I've seen recent survey from EBRD, European Bank for Reconstruction and Development, which shows that banks still do not, in carbon banks, they do not still see a threat from fintechs in the serving, for example, corporate clients or small and medium-sized firms in terms of provision of credit. So the threat occurs more in like provision of personal finance solutions, so basically serving individual customers or, well, that's pretty much it. Finally, in terms of the cost of intermediation, so the pattern is pretty much reversed. So what we observe is that in countries with more developed banking sector, financial technology helps reducing the cost of intermediation for SMEs, but it tends to increase it in countries with higher presence of fintechs. And here we think exactly in the context of these demerger studies that the risk actually for lenders is increased with focusing on these marginalized borrowers. So that's why even for fintechs, we have already valuable evidence showing that the cost of intermediation increases, whereas we don't see this for banks. But banks, so first of all, they follow the step of fintechs. They don't undercut the cost, and they provide it still at this level, or effective rate, borrowing rate would be even higher. And in this case, banks also tend then to compensate for potential higher risk which emerges in saving basically these marginalized SMEs. Now, robustness check. So we check for the indigeneity of, say, potential, say, bidirectional causality between our financial innovation indicators and then all dependent variables. And we use then generalized methods of moment, system generalized methods of moment here in order to address this. We use also as I said, we reduce the samples and just to only focusing on firms which declare actually only one main bank as a provider of financial services, and then we switch, like we move from maturity focus separately on short-term and long-term debt growth rates, and finally we employ also some alternative measures of bank innovation from global data-based innovation scoreboard, and it's exactly a number of filed patterns which captures basically kind of the input measure of innovation, then a number of granted patents which measures actually the output measure of innovation on the side of banks, and then we control for a number of deals bank has involved as a venture capitalist. Mostly it's investing in fintechs actually. One problem with this actually data is that it's by far reduced in terms of observations. So we lose half of the samples. That's why we use it more as a robustness check rather than as the main set of our results. So what we find actually in terms of all these robustness checks, the first one on the generality, actually, the results are reconfirmed, but what we get is finally we get the significance of our effect of financial innovation on the cost of intermediation. So this is panel B here. So you can see that once we address indigeneity, so the relationship is becoming positive, and we observe then that bank financial innovation tends to increase the cost of intermediation for SMEs. Finally, as I said, when we use alternative robustness checks, this is just using fixed effects model, so reconfirms the results on the access to credit, so the effect is positive, and we even use this reduced sample, but alternative measures of innovation. But the results on on the cost of intermediation remain just insignificant. But here we don't yet use our a GMM model in order to test the robustness of these results. Now, so in terms of summary, so what we find in this paper is that bank digitalization overall tends then to increase actually SMEs credit to access, but primarily actually benefiting then short-term vis-a-vis long-term when we speak about the maturity of credit. It also, if we actually talk about the robust results that we obtained by using system GMM. So we find that there is an increase in the borrowing for SMEs, but younger firms that benefit from lower borrowing rates at more digitalized banks. So this is also an interesting just finding on its own concerning these more opaque firms. And also, we find that collateral becomes less important at financially innovative banks, and finally, we find some conditional effect of credit market structure, where says there is some complementarity in fintech presence and banks affecting the access to credit, but increasing actually the cost of intermediation. So In terms of policy recommendations, since our sample is based on the EU firms, so interestingly enough, the measures, I mean, you know that the EU has invested now quite recently a lot in enhancing financial digitalization of the whole region, and a lot of Horizon 2020 or Europe grants, they exactly focus on this agenda. And so far the measures that's been taken, in fact, they been quite effective in terms of then helping SMEs to get access to credit, but unfortunately these measures are not yet sufficient in order to impact actually the cost of these financial services. So this does not fully resolve the issue of financial exclusion. And also what we argue is that it's important when the policy measures are drafted, it's important actually to take into consideration then the credit market structure, as all this relationship are conditional on the credit market structure. Just a few last words. It's we continue working with this data and extend then the focus also to SMEs performance, because it's interesting to see not only how the lending patterns change, for example, with prevalence more of short-term debt vis-a-vis long-term in terms of SMEs loan portfolios. And we simultaneously look at the effects then of all these channels on sales growth, or turnover growth, and employment growth. And we are getting some interesting results actually about the negative effect exactly of this shortening of debt on sales of SMEs. Also actually the effect tends to manifest negatively on sales via the increased cost of intermediation for banks. Sorry, for SMEs. So this is still work in progress, and so thank you. Your feedback would be more than welcome.
I haven't seen Italy in the list of the countries.
Italy, I don't remember actually if we had. I think we definitely have Spain, but let me see.
Was there a reason for that?
Yeah, I think some of the countries we couldn't include because of quite a lot of missing information, either on the side of SMEs, for example, for lending provision, more specifically for this lending patterns that we wanted to capture, or on the side of banks in terms of provision of financial innovation data. So it's just purely to do with data limitation. Though I remember you actually commented about the good quality of Italian statistics. Yeah. Yes, but I mean, we also capture, for example, Spain, which is, I think, the largest country in the EU dominated by SMEs. Yes, sorry.
Nothing to be sorry for. Could you help me think through the extensive margin? So the way, especially your results about, innovation leading to lower sales. To me, and the same thing with the cost of credit. To me, it sounds a little bit like if bank invests into that innovation, they're better able to discriminate the truly marginal, but still profitable from the market. Basically, there are groups of SMEs they wouldn't have touched before. Mm-hmm. Now they understand that some of those really risky guys are actually worth dealing mm-hmm. with. Mm-hmm. It's going to be reflected in smaller sales and higher interest rates.
Yeah, so what we observe exactly is not the case for the sample of SMEs overall. We observe actually the increase in the cost of intermediation for the whole sample of SMEs, but we observe the reduction in the cost of credit for younger firms. Not smaller, but younger. So you see maybe younger gazelle firms or like unicorns, which they tend to focus on. Yes, please.
Any more questions? Okay, then last question from me. The technology takeoff should be endogenous in a sense, right? And I mean, are you able to somehow differentiate banks which were, I understand that you're doing it from the side of the firms, but still, which were more like focused on SMEs and what type of technologies they were more likely to introduce and whether it might affect your results?
Thank you, Katerina. It's a good question. I mean, we actually do robustness checks in terms of the potential indigeneity between the two, but it's more in the sense of reverse causality. Unobserved heterogeneity is addressed at the level of firms, but it's already then absorbed in itself any heterogeneity at the level of banks because it's lower level of aggregation. So it's more via technical way we sort of deal with this problem. But I don't think we can use any selection type of models because, as I said, we focus on SMEs rather than banks in this case.
Thank you.